Hello, hello. After the meta video, we're continuing with Netflix in regards to FANG. And it is a company that is very interesting to talk about. The thing about Netflix is that being in our lives, like almost everybody has it, I had it myself for a while, as a service, I mean. A lot of people are like, okay, this is a fantastic business, it has tons of subscribers, it makes good money, is what they are saying. It's a company that will never go down, kind of forgetting what happened with Blockbuster. But it's not like Netflix is going to become a blockbuster. The thing that is very important to understand is the core business here in terms of Netflix. And I have to tell you up front, it's a business that I'm not really fond of, frankly. And the reason for this is there are multiple reasons actually. The most important thing, and you can kind of see it here in our financial statements, and I have talked about it in the past. If you take a look at a company like Netflix and take a look at their cash flow statements, of course, you can take it back to years of display, like 10 years. You can kind of see that they are making some net income here and they are positive in terms of that. But take a look at these lines, the depreciation and amortization lines, 2.2 billion, 2.7 billion, 3.5, 4.9, 6, 7.6, and continuing on and approaching for almost $15 billion. Now, what is that? Netflix is a company that in order to make income, it has to produce like series, movies, and these series that are movies that get produced obviously take up a lot of money. So they have to spend tons of money in order to do this. And when they are doing that, they are actually investing in some products, or I should say a service in this case, or almost, that gets amortized in the future. Because if you're making a series today, let's just say that you made Squid Game, it's gonna do greatly in the first few years. But the cost has to be amortized because at some point later on, it's not gonna be worth anything. And basically, this is money lost for the company, and it's money lost from the net income. It's added back to the cash flow statement because it's not a cash expense. But it's sort of like a depreciation expense for movies and series. Like depreciation, you can think about it in a clear manner. It's easy to think about it. It's let's just say that you bought a car, right? And it depreciates. Like after, let's say, 5 years from the time you bought it, it loses more than half of its value. It's the same thing with a series. After like 5 years, 10 years, it keeps losing value. And so it gets amortized. So amortization is basically depreciation, but for intangible assets. It's what it is. And so this is a cost for a company. It gets added back to the cash flow statement because it's, again, it's a non-cash expense, but yet it is an expense. And so if you go down, you'll see that the free cash flow here for the company is in the negative. Because of that, that's the core reason. And it's only 1 year, basically, fiscal year 2022, when they turned up some profit. So imagine that. The company is worth billions, and it's just making 1.6 billion in free cash flow. And in the previous years, it was even losing free cash flow. And if you take it to our stock analysis tool in the metrics page, you can kind of see here that the market cap of the company is $146 billion. Now, let's stop and think about it a little bit. If you have a company that's worth, let's say, $10 million, don't you expect it to make, let's just say, $1 million a year in profit, right? And so, if we're talking about a company that's worth $150 billion in market cap, it should be making at least like $10 to $15 billion of profit every year, at least, right? In order to, to make sense for an investor to potentially jump in. So now we're seeing an overhyped company here that is actually not making as much money as its market cap is implying here. So, and this is because it's a very popular company and investors flock in to buy this one. Now, this has two interpretations. If you are buying at any point, you can expect potentially other investors to keep buying this thing, pretty much continuing with the hype, or the company may be even doing somewhat better in the future, although they have to do way better in order to sustain this kind of valuation here, even though it has been dropping quite a lot in the past few months or so. Maybe over here it was better, but right now it's actually going up again, sitting at $328. And we will examine whether this is cheap or expensive. But hint, it's probably a little bit expensive. So this is what is important about a company like Netflix. And the other thing is that Netflix, the other very important reason is that the thing that Netflix has to remain non-obsolete. It has to remain current. So it has to keep producing new content and great content. And that's a challenge, especially with so many competitors around. It's not easy to keep producing like Squid Games every year. That's not gonna happen. Or the other series that they have been producing or movies. It's just not easy, and you have to constantly prove yourself in the market. Take it to another company like Apple, for example. Like Apple has the iPhone and has the iPad and has the Mac since like 30 years now or more actually. And so this is a core product that doesn't really change. There are some changes in regards to like smaller things, but for the most part they're selling the same product, getting it a little bit better every year. But this is just so challenging here for a company like Netflix, and you have to take that into account. This company will have to keep making more expensive and better productions in order to keep up with the entertainment industry, which is a fierce industry and very competitive industry here. And in order to remain current, you have to keep spending tons of money. It's gonna be hard for them to turn profit. That's the core reason why Netflix is one of the companies that I'd have to see it go down quite a lot before I consider buying it. But let's take a look at the financials. Maybe some people are okay with the risk because as long as you understand this kind of risk, you may be like, okay, maybe I'll just buy a little bit, potentially thinking that it could reach like the previous levels here on a hype period similar to what has been happening in the previous years. And you can kind of see here that the hype was real. Like the P ratio was super high. Now it's getting a little bit lower because the market has been pretty much selling all over the place, especially the tech industry. And the price to free cash flow is still expensive. Why? Because it's what we talked about, right? They're not making money in terms of free cash flow, and it's the expenses are heavy over here. The capital expenditures, you have to produce all these movies, all these series, all that stuff. It's expensive, super expensive, and it's really hard to turn up some profit here. And the company also has a lot of debt. Another typical thing for companies although it's going down. Another typical thing for companies of that sort, like media companies, they have to incur a lot of debt because they have to keep producing content, right? It's not easy, it's expensive. Content producing is super expensive. And then I think margins are also dropping a little bit, not too much though, and they are not super high. And they may keep dropping a little bit just because they have a lot of competition around right now. So things to understand that are very important for companies of this sort. Now I kind of want to take a look at the income statement here. Again, I have recently added the years to display, like 10 years over here, 4.3 billion in revenue to 31.6 over here. Now they have been increasing their top line, that's the revenue, which is awesome. But what about the bottom line? Take a look at this one. They started with 112 million and stayed at about $1 billion range for a while. This is many years here. It's like 7 years. So they weren't really making any profit, and they still make little profit compared to what the company is worth. Again, is what we talked about. And remember, they have to keep spending a ton to produce more content, is the thing. Now, the balance sheet of the company, you will see that they have about $21 billion of equity. But this may have to do with the stock actually that they have been selling in the open market. And you can kind of see here that they have been selling a little bit. The outstanding shares go up, not tremendously though, not that much is the thing. And the final financial statements that makes a ton of sense to take a look at is the cash flow. Because again, you can kind of see, and the very important thing, how much the depreciation amortization has been growing through the years as the company keeps producing more and more content here. They are spending tons of money in amortization pretty much. It's not actual cash, but it's an expense. And take a look at the capital expenditures as well. These are not heavy over here, but they're mostly accounted towards depreciation amortization in this situation. But there is also investments in property, plant, and equipment here. Their investing activities is like minus 2 billion over here. Now I think it's a little bit interesting to take a little bit of a look at Senator trades here because it's all green. It's just two purchases though, as you'll see here. Joe Schottheimer purchased a couple of lots over here, and you can see the exact dates of filing and all that. No, so not too much activity here, but still, it's there's not much selling as well, is the thing. So not too much activity, just a little bit more of buying. Now, the important thing, what about our stock evaluator? What is the stock worth? What is the company worth here in terms of an investor, as far as an investor is concerned? And so you will see that the revenue growth of the company approximates about 23% a year and you can kind of see it laid out here, and 6% was the last year. We have to go a little bit conservative, of course, because the current time kind of has to, you have to be conservative for the current period of time. The current economic stance is a little bit sketchy right now throughout the world. And so we're going to go, let's just go 3, I'm going to go 6 and 9 for my revenue growth potential. And net income margin, as you'll see here, you can kind of see it in our tool. It's very low for the company. And again, you can understand it because of the company has been, spending a ton. Again, as I mentioned, it's very expensive to produce this kind of content. And so their margins are about 11, 14%. I'm going to go 11, 13, and 14. And yeah, this kind of worries me a little bit because their margins could potentially, as I mentioned earlier, drop because of competition. So far, these are not horrible, of course. These are okay margins. But I'm worried that they could go down potentially with the new streaming services maybe. Now the free cash flow margin, will be a little bit all over the place. We talked about it, and again, very normal for these kinds of companies. Now we kind of have to assume that the company is going to be generating something like 80, 90, and 100%, without counting the capital expenditures and all that. Because we want to see what kind of price it makes sense to buy the company for. And the company has been non-profitable for many years, again, is what I talked about earlier. So it's we're going to be using something that's rather typical, 80, 90, and 100, and 13% for our annual return here, in the case we make that. So, as you'll see, it probably makes sense to be buying a company like Netflix near $150 to $200, and then it would still be relatively risky, I think. And so right now at 327, not my thing. I think it's expensive, and for the reasons that I talked about earlier, I'm out, as they would say in Shark Tank. It's just not an investment for me over here. If it maybe halves itself at some point, I could be interested. But over here, I think there may be other opportunities for potentially even other streaming companies. If you are so much interested in buying such a company, again, it's not my biggest, my best ones. It's not the ones that I would pick. These kinds of companies, media companies of that sort. But if it's some company that is underpriced, it may be worthwhile. This one, Netflix, even though it's down quite a lot, I think it's still expensive, and this is what I would like to see, maybe around 150. Could probably make sense for me to buy this one. But do tell me what you think about it. Of course, leave a comment below. I'd love to hear your opinion. And remember to leave a like and subscribe. Of course, our Patreons have access, full-blown access to the tool that I'm using here. So if you're interested in becoming one, you can find the link in the description box below this video, or just visit myinvestorsheaven.com. And I'll see you soon. Bye-bye.